Ready for a deep dive into a side of Isaac Newton you probably haven't heard about? Forget the laws of motion and gravity. Today we're talking about Newton the investor. Yeah, you heard that right. The man who cracked the code of the universe also tried his hand at the stock market. And, well, let's just say even geniuses can make mistakes.
It's a bit of a paradox, isn't it?
Yeah.
We tend to think of these iconic figures as infallible, brilliant in every aspect of their lives, but Newton's story is a great reminder that even the sharpest minds are still human, prone to the same emotions and biases as the rest of us.
Exactly. So to set the stage, we're talking about the South Sea Bubble, one of the most infamous financial bubbles in history. Imagine it's 1711, and this company, the South Sea Company, pops up making these grand promises about solving Britain's national debt, their plan. Get exclusive trading rights in South America, a land that seemed to be overflowing with riches, spices, gold, you name it. Must have sounded pretty tempting, right?
It was a very alluring proposition, especially in a time when exploration and colonial expansion were all the rage. People were captivated by the idea of striking it rich in these far-off lands. The South Sea Company, with its royal charter and promises of unimaginable wealth, quickly became the hottest investment around.
But here's the catch, and it's a big one. The company's stock price wasn't actually based on, actual success in South America. It was pure speculation, people buying the stock not because the company was doing well, but because they thought they could sell it later at an even higher price. Sounds kind of like gambling, doesn't it?
It was a gamble many were willing to take. The truth is, the South Sea Company was built more on hype than reality. Their actual trading operations in South America were pretty limited, and those huge profits they boasted about, well, let's just say they were a bit exaggerated.
Okay, so now let's bring Isaac Newton into the picture. At first, he approached the whole thing with his signature cautious brilliance. He bought some stock early on, made a decent profit around £7,000, which was a lot of money back then, and then wisely decided to cash out. Seemed like our genius was immune to the hype, at least at first.
His initial approach was a classic example of Newton's methodical thinking. Observe, calculate, and act with logic and discipline. Had he stopped there, this would be a very different story.
But as the South Sea Company stock kept going up and up and up, even Newton couldn't resist the fear of missing out. We all know that feeling, right? That everyone else is getting rich, I don't want to be left behind feeling.
Absolutely. That fear of missing out, or FOMO as we call it today, is a powerful psychological force. It affects everyone, even someone with an intellect as formidable as Newton's. It speaks that deep-seated human desire to belong, to not miss out when others are reaping rewards.
So Newton decides to jump back in. But this time, instead of just dipping his toes in the water, he goes all in, investing a much, much larger sum. Makes you wonder, did he think, hey, if I can figure out the laws of the universe, I can surely outsmart the stock market?
It's a fascinating question, isn't it?
Yeah.
Did Newton's confidence in his own intellectual abilities lead him to underestimate the inherent risks of the market? It's almost ironic. The very brilliance that made him famous might have contributed to his downfall.
And a downfall it was. Like all bubbles, the South Sea bubble eventually burst. Investors panicked. They realized the company's promises were basically empty, and everyone was frantically trying to sell their shares. It wasn't a slow decline, it was a full-on market crash. What must that have been like?
Chaos, utter chaos. Imagine the scramble to unload shares as the dream of easy riches evaporated. Fortunes were wiped out practically overnight. The stock price plummeted, leaving countless investors, including, yes, Isaac Newton, reeling from the financial blow.
Okay, so how badly was Newton hit?
He lost a staggering £20,000. In today's money, that would be millions. And it wasn't just about the money. Imagine the blow to his pride, the realization that the intellect that had unlocked the secrets of the universe couldn't predict the whims of the market.
And that brings us to one of the most famous quotes in financial history. A defeated Newton reportedly said, I can calculate the motion of heavenly bodies, but not the madness of people. That pretty much sums up the whole experience, doesn't it?
It really does. That quote shows that Newton understood that while he could quantify the physical world, human behavior was a whole different ballgame. It's unpredictable, driven by emotions, often defies logic. And that's a truth that's as relevant today as it was back then.
So what can we learn from all of this? It seems like there are some pretty valuable lessons here that go way beyond just investing.
Absolutely. For starters, Newton's story is a powerful reminder that even geniuses have biases. He, like all of us, was susceptible to greed, fear, that urge to follow the crowd when everyone else seems to be winning. It shows us how much psychology plays a role in our decisions, even when we think we're being totally rational.
It's amazing, really. Here's Newton, who spent his life trying to understand the order of the universe, and even he couldn't escape those basic human instincts. Guess it just goes to show we all have a bit of that madness in us.
We do, and it's important to keep that in mind, not just when we're thinking about investing, but in any area of our lives where emotions and logic are at play. Understanding those biases, recognizing them, can be incredibly powerful for making better decisions, more successful decisions.
So, what else can we learn from Newton's experience? What are some key takeaways that might help us avoid making similar mistakes?
Well, there's the inherent risk that comes with speculation. The South Sea Company, it was built on hype, on unrealistic expectations, not on solid fundamentals. It's tempting to chase quick riches, we all want that, but as Newton's story shows, it's often a recipe for disaster.
And it's interesting how this pattern seems to keep repeating itself throughout history. We see these waves of speculation, these market bubbles popping up again and again. Like, remember those meme stocks a few years back? Or the recent craze in the crypto world?
Exactly. The specific assets might change, the technologies involved might evolve, but the underlying psychology, the fear, the greed, that herd mentality, it all feels eerily familiar.
So, understanding those patterns, recognizing those psychological triggers, that seems key to avoiding those same mistakes. What are some other strategies we can use to navigate these complexities?
Well, one crucial lesson is that timing the market perfectly is incredibly difficult, if not impossible. Newton's initial success, it was likely a combination of luck and good timing, rather than some special insight. And when he tried to replicate that success, well, we saw how that turned out. It highlights the danger of chasing short-term gains and the potential benefits of taking a more long-term approach to investing.
Right. It's like trying to catch lightning in a bottle, focusing on building a solid portfolio, looking at a company's actual performance, its potential for growth, rather than just following the hype. That seems like a much more sustainable strategy.
Absolutely. It's about understanding the true value of an investment, not just getting caught up in the excitement of the moment.
So, how do we avoid falling into the same trap as Newton? What are some concrete things we can do to make better, more informed decisions?
One crucial lesson, and it might sound counterintuitive, is the importance of not being afraid to go against the crowd. Newton got swept up in that herd mentality, buying in when everyone else was buying, and selling when everyone else was selling. But crowds can be fickle. What seems like a sure thing can quickly turn into a disaster.
So, it's about thinking for yourself, doing your own research, not just blindly following the masses. It's about being a contrarian.
Exactly. A contrarian investor is someone who goes against the prevailing trends, against popular opinion. It can be a successful strategy, but it also comes with its own risks. The key is to base your decisions on careful analysis, on sound judgment, not just on being different for the sake of it.
So it sounds like a balance of independent thinking and thorough research is key. But even with all the research in the world, we're still human, right?
Yeah.
How do we manage those emotions, those biases that can cloud our judgment?
And that brings us to another essential lesson from Newton's story, and it's the power of humility. Here he was, arguably one of the most brilliant minds in history, yet he fell prey to the same emotional traps as anyone else.
It's like that saying, pride comes before the fall. We all have a tendency to overestimate our abilities, especially when things are going well. But acknowledging our limitations, being open to learning from our mistakes, that's crucial for long-term success.
Exactly. And perhaps one of the most valuable lessons we could take from Newton's experience is that it's not about avoiding mistakes altogether. It's about learning from them. It's about reflecting on our decisions, understanding what went wrong, and using those lessons to become better investors, better decision makers in all aspects of our lives.
So even a genius like Newton can stumble. And that's okay. What matters is how we respond to those setbacks. Recognizing that we're all works in progress, constantly learning and evolving. That's actually a pretty empowering thought.
It is. And it underscores the importance of not getting discouraged by our mistakes, but seeing them as opportunities for growth, for self-improvement.
So even though Newton's experience with the South Sea bubble might seem like a distant event from centuries ago, the lessons it holds are incredibly relevant for us today. It's a story that reminds us that we're all human, susceptible to the same biases, prone to making similar mistakes.
It's a story about the interplay of brilliance and human fallibility, a reminder that even the brightest minds can be swayed by emotion, and that true success lies in understanding those vulnerabilities and using them to our advantage.
It's a timeless reminder that while knowledge and intelligence are essential for success, they're not enough on their own. We also need emotional intelligence, self-awareness, and a healthy dose of humility.
Absolutely. It's about understanding that the markets and life itself are complex systems, influenced by countless factors, some of which are beyond our control.
It seems like we've uncovered some pretty profound insights from this deep dive into Isaac Newton's financial adventure, but I'm curious to explore how these lessons play out in the modern world. How do these historical patterns manifest in today's markets? And what can we do to avoid falling into those same traps?
That's a great question, and one we'll delve into further as we continue our exploration. We'll examine the parallels between the South Sea bubble and more recent financial bubbles, and discuss practical strategies for navigating the complexities of today's market.
Sounds like we have a lot more ground to cover. We'll be right back after a short break to delve deeper into the modern implications of Newton's story.
Welcome back. So you might be thinking, okay, that's an interesting story about Isaac Newton, but what does an 18th century stock market bubble have to do with me in the 21st century? And that's exactly what we're going to unpack now. You might be surprised how relevant those lessons from centuries ago still are today.
That's the fascinating thing about human behavior. As much as the world around us changes, the underlying psychology, it remains remarkably consistent. Those same emotional triggers that drove the South Sea bubble, they're still at play in the markets today.
It's like we're hardwired to repeat certain patterns even when we know better. So how have these historical patterns manifested in more recent times? Can you give us some examples? Absolutely. Think about the dot-com bubble of the late 1990s. Fueled by the excitement of the internet, companies with little to no revenue were suddenly valued at these astronomical sums. Investors poured money into anything with a .com attached to its name, hoping to get rich quick. The parallels with the South Sea bubble are striking. The speculative frenzy, the disconnect from fundamentals, the inevitable crash.
It's like history rhyming, as they say, and we've seen similar patterns play out in other markets as well, haven't we?
Indeed. The 2008 housing crisis is another prime example. Easy credit and lax lending practices led to this surge in home prices, creating a bubble that ultimately burst, leaving many homeowners underwater and triggering a global financial meltdown.
So those same ingredients, speculation fueled by easy money, a disconnect from the real value of the asset, it seems like a recipe for disaster. And these are just a couple of examples, right?
Yes, unfortunately, these patterns are more common than we'd like to think. Even in recent years, we've witnessed similar dynamics in the world of cryptocurrencies. While there's certainly innovation and potential in the crypto space, we also saw speculative bubbles fueled by social media hype and the promise of quick riches. The result: massive price swings and significant losses for many investors who got caught up in the frenzy.
It's almost as if certain market conditions create a breeding ground for these kinds of bubbles, where rational decision-making gets thrown out the window and emotions take over.
That's precisely what happens. When you have a combination of easy access to capital, a compelling narrative, a fear of missing out, and a lack of understanding of the underlying asset, you create a fertile environment for speculative bubbles to form.
So if these patterns are so deeply ingrained in human behavior, how can we protect ourselves from making the same mistakes?
It starts with awareness, recognizing that these cycles exist, and understanding the psychological drivers behind them. That's the first step. We need to acknowledge that we're all susceptible to those emotional triggers, even when we think we're being perfectly rational.
It's like knowing your enemy, right? The more we understand those psychological biases, the better equipped we are to combat them. But what are some practical steps we can take to avoid falling into these traps?
But going back to Newton's story, remember how his initial success was more about timing and luck than any special insight. Trying to time the market perfectly is an incredibly difficult, if not impossible, task.
So chasing those short-term gains is probably not the best strategy in the long run.
Exactly. Instead, focus on building a solid portfolio based on sound fundamentals. What does that mean? It means looking for companies with a strong track record, a viable business model, and real potential for growth. It's about understanding the true value of an investment, not just getting swept up in the latest trend or hype.
That makes a lot of sense. It's about looking beyond the surface and really understanding what you're investing in. But sometimes it feels like the market moves so fast. How do you stay ahead of the curve?
That's where diversification comes in. Remember, Newton's big mistake was putting all his eggs in one basket. By spreading your investments across different asset classes, different sectors, even different geographies, you can mitigate risk.
So it's like a safety net. If one investment goes south, you're not completely wiped out.
Exactly. And don't forget the power of a long-term perspective. Short-term market fluctuations are inevitable, but over time, the market tends to reward those who invest in companies with solid fundamentals and a proven track record.
So patience is a virtue, and it seems like doing your homework is key too. Don't just buy into something because everyone else is. Do your own research, understand the risks, and make informed decisions based on your individual goals and risk tolerance.
I couldn't agree more. Blindly following the crowd is often a recipe for disaster. Remember, Newton got caught up in that herd mentality during the South Sea Bubble. It's essential to develop your own independent judgment.
But how do you avoid getting paralyzed by fear? The market can be volatile, and it's easy to get spooked when things start to go down.
That's where having a clear investment plan and sticking to it comes in. When you've done your research and you understand your risk tolerance, you're less likely to make impulsive decisions based on fear.
It's like having a roadmap, a guide to help you navigate those inevitable market storms. But let's face it, even the best laid plans can go awry. How do we deal with those inevitable setbacks, those losses?
That's where the lesson of humility becomes paramount. Remember, even Newton, a genius by any measure, made mistakes. Acknowledging that we're all human and prone to making errors is crucial. It's not about avoiding mistakes altogether, but rather about learning from them.
It's about seeing those setbacks not as failures, but as opportunities for growth. It's about reflecting on our decisions, understanding what went wrong, and using those lessons to become better investors.
Precisely. And it's about remembering that investing is a lifelong journey. There will be ups and downs, but by staying informed, making informed decisions, and learning from our mistakes, we can navigate the market with greater confidence and ultimately achieve our financial goals.
So even though Newton's story took place centuries ago, the lessons it holds are incredibly relevant for us today.
They remind us that human psychology plays a powerful role in financial decision-making. By understanding those biases and adopting a disciplined and informed approach, we can avoid repeating the mistakes of the past and navigate the market with greater success.
It seems like we've covered a lot of ground, but I'm curious, what are some specific takeaways from Newton's story that we can apply to our own lives, not just in terms of investing, but in broader decision making?
That's a great question, and one we'll explore in more detail as we continue our deep dive into Newton's financial folly and its implications for how we approach not just investing, but decision-making in all aspects of our lives.
Welcome back to our deep dive into Isaac Newton's, well, financial missteps. We've explored the South Sea Bubble, and it's really interesting how much it resembles some more recent financial bubbles. But let's shift gears a bit. Let's talk about what we can learn from all of this, beyond just the do's and don'ts of investing.
It is fascinating, isn't it, how this story about a scientist from the 1700s and a financial bubble can still be so relevant to us today. I think one of the biggest takeaways is that, well, even someone as brilliant as Newton could make some pretty big mistakes. It reminds us that intelligence and knowledge, those aren't always enough. We need emotional intelligence too. We need self-awareness and a good dose of humility.
It is a bit humbling, isn't it, to think that even a genius could get caught up in all the hype and make decisions that seem, well, pretty irrational in hindsight.
It's true. Newton's story really highlights how powerful emotions are. They can influence our decisions, even when we think we're being totally logical. Fear, greed, that fear of missing out, they can all cloud our judgment and lead us down a path we might regret later.
It's like those emotions kind of hijack our brains sometimes. We get so caught up in the excitement or the fear, and we lose sight of the bigger picture.
Exactly. And that's why it's so important to be aware of these emotional triggers, to understand how they can influence our behavior. Once we recognize those patterns, then we can start to develop strategies for managing them.
So what are some practical things we can do, to keep our emotions from getting the best of us?
One strategy is to just pause, before you make any big financial decisions. Take some time to just reflect. Step back from all the hype and really consider the potential risks and rewards. Ask yourself, is this decision, is it driven by fear, by greed, or is it aligned with my long-term goals and my values?
That's a great point. It's like taking a deep breath before you hit that buy or sell button.
Right. And another strategy is to get different perspectives. Talk to people you trust, people who have different viewpoints and financial expertise. Don't just rely on your gut feeling or the opinions of people who are caught up in the same hype.
It's like getting a second opinion or a third opinion even before making a big decision.
Exactly. And don't underestimate the power of having a well-defined investment plan.
Right.
When you have a clear roadmap, you're less likely to make those impulsive decisions based on emotions or just short-term market movements.
So it's about having a strategy, right? Sticking to it, not getting distracted by all the noise.
Exactly.
Yeah.
And remember, even with the best plan, there will be times when things don't go as expected. And that's where the ability to learn from your mistakes, that becomes so crucial. Don't beat yourself up over losses. Instead, look at them as opportunities for growth, for reflection. Ask yourself, what could I have done differently? What lessons can I take from this experience?
It's like turning those setbacks into learning moments,
Yeah.
rather than just dwelling on the negative.
Exactly. And finally, don't underestimate the importance of patience and discipline. Building wealth is a marathon, not a sprint. It takes time, it takes effort, and a willingness to stay the course even when the market gets a little crazy.
It's like those timeless principles that apply not just to investing, but to life in general, right? Patience, discipline, and the ability to learn from our mistakes.
Absolutely.
Yeah.
And if there's one big lesson we can take from Isaac Newton's Financial Folly, I think it's this. Knowledge and intelligence are valuable, but they're not enough on their own. We also need emotional intelligence. We need self-awareness and a healthy dose of humility to navigate the complexities of the market and really of life itself.
So even though Newton's story happened centuries ago, the lessons it holds are timeless. They remind us that we're all human, we're all susceptible to the same biases, prone to picking similar mistakes.
It's a story that goes beyond the specifics of the South Sea Bubble. It speaks of this broader human experience. It's a reminder that even when we're brilliant, even when we achieve great things, we're still vulnerable to emotions. And to that allure of easy riches.
It's a cautionary tale for sure, but it's also a story of hope because once we recognize those vulnerabilities, then we can start to manage them. We can start making better decisions, more successful decisions.
Exactly. And by embracing the lessons of history, we can navigate the complexities of the market and of life itself with more wisdom, more resilience, and ultimately greater success.
Well, it seems like we've surfaced from our deep dive into Isaac Newton's financial journey with some pretty valuable insights and some practical advice too. Thanks for joining us on this exploration. We hope you found it as enlightening as we did.
And remember, the principles we've talked about today, they don't just apply to finance. They apply to decision-making in all aspects of our lives. By understanding the influence of our emotions, by cultivating self-awareness, and by embracing those lessons of history, we can all make more informed choices and more fulfilling choices.
Until next time, stay curious, stay informed, and keep exploring the fascinating world around us.